I understand why it's appealing and tempting to invest in the biggest names listed in the stock market. But data suggests that you won't necessarily get the best returns by doing so. Whilst we all know that past performance is no guarantee of future results when it comes to investing, that certainly seems to be true for some of the largest firms on the US stock market over the years. As companies grow to become some of the largest firms trading on the US stock market, the returns that push them there can be impressive, that's for sure. But not long after joining the top 10 largest companies measured by market capitalisation, that's to say the total market value of the company, these stocks on average lagged behind the market. Let's break down the data a bit further. Dimensional Fund Advisors analysed almost 100 years of data from 1927 to 2021, looking at the top 10 largest companies in the US stock market. The average annualized return for these companies over the 3 years prior to joining the top 10 was more than 25% higher than the market. There's that impressive growth that propelled them logically to become one of the biggest US stocks. In the 3 years after they landed in the top 10, their annualized return was less than 1% ahead of the market. 5 years after joining the top 10, these companies were, on average, underperforming the market by 0.6%. That's a pretty rapid and significant turnaround from their earlier performance. The gap was even wider 10 years later, with an underperformance of 1.5%. That's minus 1.5%. A great example of this trend is a brand we all know, Intel. The technology giant posted average annualized returns of 29% in the 10 years before the year it climbed into the top 10. Now that's impressive growth, and if you'd bought into the company during that stage, you would have probably benefited hugely. That's to say, if you were what's known as an innovator or early adopter and got in at the beginning. However, if you were later to the market as part of the early or late majority, quite frankly where most of us sit, you may not have fared so well. In the next decade, Intel underperformed the broad market by nearly 6% per year. The story is not dissimilar for Google. Its annualized excess return 5 years before it hit the top 10 dropped by about half in the 5 years after it joined the list. It's important to bear in mind that expectations about a firm's prospects are reflected in its current stock market price. My recommendation to you is to buy a globally diversified portfolio rather than trying to pick specific stocks. Remember, the market price is all the information currently is in the current market price. So unless you know something that the market doesn't do, there's no real reason for it to outperform the market. Thanks for checking out my YouTube channel. I'm Justin King. I'm a certified and chartered financial planner, and my aim is to help you have a successful life, and that often involves understanding your money. Please press the like button if you've enjoyed this video, and of course subscribe so you can be let know when I put out new video content. Once again, thanks for watching.